Hello, everyone. So I will be working through this problem in a series of lectures that focuses on two or three accounting cycle steps. And we will have one of these for each topic that we attend to so that you're always placing these topics back into the accounting cycle and hopefully building that familiarity and that repetition so that you completely understand what transactions belong in which parts of the cycle, how the cycle works, and combines to give us the financial statements. So this one is a bit of a basic overview of the accounting cycle. It reflects more basic transactions that I hope you recall from your introductory class. And if there are some issues with some of the transactions that you don't recall, please reach out and let me know so that we can discuss them by email, or if you need to, set up a Zoom session to talk about them. What we start with here is very important. We always need to know where we're beginning. So in this case, we have Richter, a retail company that is providing us with a post-closing trial balance for the year ending 12/31/4. So this year just ended, and the company closes its books at the end of every month. So every company will have a different approach, a different accounting period. Some companies will do monthly accounting periods where they roll through all 8 steps of the accounting cycle every month. Some of them will do it every 3 months, which is a quarterly accounting period. And some companies will do an annual adjustment. So they won't do the accounting cycle until a full year has passed. So in this case, we have our company closing its books at the end of every month. And this was the result of December's operations because it's the post-closing trial balance for the year ending 12/31/4. So this was created at December 31 of the year X4. And this is all about where the accounts are at that date. Now, we're in the new year, right? We are now in January. So the company has additional transactions. We're going to turn our attention to what's happening to the company in January, and we will reflect back on the importance of this ending trial balance for the prior year once we start to get into step two. But our very first step is to create journal entries and record the transactions that happened during the period. And that's why we turn our attention there at this moment. The very first piece says that Richter paid its rent for 6 months, amounting to 18,000, and prepaid a year's worth of insurance premiums amounting to 12,000. So on the first of the year, it basically cut a check for its rent for 6 months and also cut a check to the insurance company so that it can get coverage on its insurance for a full year. And when we record that, we have to make the date, of course, so that we can keep track. And the journal entries are made in chronological order as they've happened. So we have prepaid rent and prepaid insurance. Those are the two accounts we're establishing here. So two different prepaid accounts. The prepaid rent's going to last us for 6 months. The prepaid insurance is going to last us for a year. And we have to settle up with some cash in order to have that happen. Now, this is something that we do all the time as individuals. We pay for our month's rent at the first of the month. We pay, hopefully, our insurance ahead of time so that we have that coverage over time. And we have 18,000 for the rent and 12,000 for the insurance. So altogether then, we have $30,000 of cash that we spent in order to make this happen. We basically exchanged one asset, cash, right? Cash is being credited, so our assets are being reduced. For two assets, this entitlement to have our rent covered for 6 months and an entitlement for our insurance coverage for a full year. These two are also assets since they have already been paid. Their economic benefits will extend over the time of the contract. Richter collected $47,000 from credit customers. So this would be a collection on some of the people that owed them money still at the end of the prior period. So notice that they have accounts receivable of $67,000 listed as an asset on their post-closing trial balance. This means that there's $67,000 of customers who have either taken a good or a service from my company and have not yet paid. We invoiced them because we completed the work, but they haven't paid us cash. Now we are getting money from some of those customers that we consider our accounts receivable. So this is on 1, 2. And because we are receiving money, we're collecting that from our customers. We debit the cash account for $47,000. And because they've paid us, we no longer expect their accounts to be receivable. We've received it. So we have to take away $47,000 from those receivables and reduce that economic benefit that we've recorded as accounts receivable. This is another transaction where we are receiving an asset, cash, and using up another asset, which was accounts receivable. The next transaction suggests that we recorded product sales on credit amounting to 40,000. And the inventory, because we sold product, right? Product sales. The inventory that we sold cost my company $21,000. And so we made the sales on credit, which means that we have more accounts receivable coming in. And if I give you this inventory cost, then we also have to account for the fact that we no longer have that inventory. So we have really two transactions happening here. We have the sale, which we would record as an increase to our receivables. And this all happened on January 3rd. So we have some new receivable customer accounts from this sale, and there were 40,000 of those. And we can record sales revenue because we sold the product. Remember, there are just two criteria to recording revenue that we're really worried about in intermediate one. One is that we have performed our obligations. So we've provided a product, we've provided a service. And then the second is that we have a reasonable expectation to collect an asset based on that delivery of product or services, our earning of that. And we have a reasonable expectation when we have an established account with a credit customer. So that shows me the sale. And my assets do rise because I now have more credit customers that I can collect cash from ultimately. And I can record some net income because I've had an increase in assets due to the results of my operation. Going back to that definition of revenues. As I mentioned, I gave you a cost for the inventory, and we didn't just make $40,000 of revenue at zero cost. We had to either purchase or make this inventory in order to sell it. And now is the point that we want to match the cost of the inventory because it provided our sales revenue. That's the expense recognition principle. So for inventory, we call that expense cost of goods sold or COGS. You almost always see it shortened as COGS, but that it means the cost of goods sold. In this case, that cost of goods sold is $21,000. And this is a cost, but we recognize it as an expense. Remember, we recognize expenses when the cost we paid helps generate revenue. The cost in this case is the cost of our products, and they generated revenue when we sold them. So now we recognize the $21,000 as a reduction to net income. We spent that $21,000 cash somehow, some way at some point, but it doesn't matter when we spent the cash. What matters is when that cash expenditure of $21,000 for this inventory helped generate revenue. That is the accounting definition of an expense. Recognize them when the cost helps generate revenue. We also need to lower our inventory account because we had a pool of inventory to sell, 23,000, but now we've sold 21,000 of it. So that will result in a reduction of our inventory, which needs to be noted as a credit to the inventory account and ultimately reduces our assets. All right, so on 1.5, it says that Richter settled $24,000 of its outstanding payable with its inventory vendors. When we have inventory vendors that sell to us on credit, right? That means they're delivering inventory without collecting cash payments from us for the inventory they're giving my company. This goes into accounts payable. So when it says it's settling its payable with suppliers or vendors, those suppliers or vendors would be seen, or the accounts that we owe would be seen in accounts payable. So accounts payable aren't just every single account in the world. It's specifically accounts that we have with the people with the other businesses that we interact with that supply us with goods. Okay. Maybe supplies, maybe inventory, but goods. So now we settled our payable. We paid that off, right? Settled means we're squaring it off. We're zeroing our account with somebody. So we don't have $24,000 of this payable. That means that on January 5th, I need to reduce my liability because I don't owe as much if I just paid 24,000 off. And so that account payable should be reduced with a debit, reduces my liabilities, $24,000. And of course, I have to settle that out with cash as a credit, which means my assets are dropping. On the next dated transaction, the company purchased $25,000 of inventory on credit with inventory vendors. So we paid some off, right? We paid off some of our outstanding account, but now we're drawing upon more account, more liability because we're purchasing on credit. We get $25,000 of inventory with this purchase, and we also pay, my company, Richter, pays $250 of freight costs in cash. So how are we going to manage this one? Now, basically, everything that my company has to pay to obtain the license or the title to the inventory and bring it to its place of business should be included in the inventory account. So we had to pay the company $25,000 to get title to the inventory to make it ours. But then we also had to pay $250 to bring it to our place of business. That too gets included in inventory. So I would debit inventory, and the total is $25,250. And I paid really through two means. First was the 25,000 that was purchased on credit. So this is now going to increase my accounts payable by 25,000. It's a liability, so I need to credit it. It is increasing my liabilities. Obviously, getting this inventory as a debit is increasing my assets. But then I paid cash for the freight aspect of bringing the inventory to my place of business. And while I included that in the inventory asset per GAAP, I record the credit, the payment amount as a credit to cash because I did not pay for the freight by saying I owe someone money. I just paid it out in cash. On 110, we have another product sell. They recorded product sales at 32,000, paid for with cash, right? So they sold the product to customers that paid with cash, and the inventory cost the company $14,000. So it's going to be very much this series of two entries where we recognize the revenue from providing a good in this case and have that reasonable expectation because we collected, instead of accounts receivable, cash. But then we also have to match the cost of the inventory to the revenue that we just generated from selling it. So it's going to be the same two with slightly different accounts. We received cash this time for 32,000. We can record sales revenue for that because, as I mentioned, we have delivered the product and we have realized the value in consideration for that provision of the product. We have $32,000 of cash that came in, so we can record that as sales revenue. The cash is an asset, and the service revenue lets me increase net income from the operations of the company. But we now need to attend to the cost. We made $32,000, but we didn't make it from nothing. We had to obtain the inventory, and it said the inventory cost us $14,000. So on that same date, I would match the expense of that inventory as cost of goods sold, 14,000, and recognize the fact that because I record my inventory at what it cost, I have to reduce my inventory account by $14,000. So cost of goods sold reduces my net income, and debiting cost of goods sold reduces my net income, and crediting inventory reduces my assets. Let's see, the next piece tells me that Richter determined that $11,000 of its outstanding customer accounts, the credit accounts, outstanding customer credit accounts. What account is that up on my post closing? Remember, would be referring to accounts receivable. When my customers have accounts with me, those are accounts receivable. So we're holding on to a lot of accounts receivable, but this tells me that 11,000 are just not going to be able to pay me. When this happens, this might be a journal entry that's a little more specific. You might not remember off the top of your head, but it's a very important one for us to begin working with again. So when they tell me they can't pay me, I have to get rid of their accounts. The idea of the account receivable is that it's an expected future economic benefit because I'm expecting the people whose accounts I have to pay me. But once I've identified accounts that will not pay me, I can't keep them around as an account receivable anymore. So I do have to credit my accounts receivable. And in this case, we had $11,000 of those accounts that are going to not pay us. So that's the 11,000. And I have fewer assets. Now, what's the debit? The debit is going to be for the account that I have already set up. And when I'm working under GAAP, I always have this account set up for these bad debts. The truth is, I already have a running estimate of people that I believe are not going to be able to pay me. Now, this is just a hypothetical estimate until I actually see that someone is not. You can think of it almost as the company budgeting a certain amount of bad debt, or what we call Now, credit losses. So this allowance allows me to draw from some of these customer accounts. I've already booked 3,350. It wasn't quite enough. We'll see what happens when we start posting it up to the ledger. But this is the allowance for credit losses. And we would want to debit it by 11,000. Now, the allowance for credit losses is what is called a contra asset account. Just so you know, it's not a liability, it's not equity, it's not net income. It is an asset. As we debit it, assets go up because any balance in a contra asset, contra, right, means against, goes against. So if it has a balance, it means it is reducing my assets by 3,350. As I get rid of that balance, it is not reducing my assets as much. So I debit it by 11,000, that increases my assets. Contra assets, in terms of their effects, are just like asset accounts. When I debit them, assets increase. When I credit them, assets decrease. And again, it doesn't matter that for this account and only this account, okay? Only this account for now. There are other accounts we can do this, but for this account for now, it doesn't matter that I have reduced it below its credit balance. Certain accounts I can do that with. Certain accounts it makes no sense to do that with. Like, for example, um, could I ever have a credit balance of cash after a transaction? Could I credit cash by $40,000 when it only has a balance of 35? No, because I would be spending, if I credited cash by 40,000, I would be spending money I don't have, right? Cash is a real thing. Accounts receivable. This is a real list of people who really do owe me money. Now, the allowance for credit losses, this is an accounting account. This is a hypothetical of how much we believe could be bad. Now, in this case, yes, we highly underestimated the amount of people that would go bad on us, but that's okay. And we'll see how it can fix itself further into the cycle. All right, so we got the 14th. The 15th says, I paid employees monthly wages of $48,000. This settled the prior payable and compensated them for work for the first half of January. So I paid them $48,000. The first, what happened then was it said it settled the prior payable. So this wages payable that was on the post-closing balance has been paid off, right? 23,000. I paid 48,000, right? So I owed my employees 23,000 from the prior period. That's the first place I'm going to take it. So that wages payable was accrued last period, right? $23,000. That means I'm paying them for work they did back then, right? Um, After I paid the work back then, the second part it said was that I was also paying the work they've done in the first half of January. Now, that payable didn't come from their work in the first half of January. It was already recorded before January even started. So, in order to record the work they did in the first half of January, we need an additional debit because we paid $48,000 to our employees. We owed them 23. So, the amount they must have earned during this first half of January was 25, the missing amount, right? 23 from the prior. We paid 48 in total. This must have been the amount they earned. This would be wage expense because I am actively now paying them for revenues that I'm generating in this accounting period. So I recognize the expense of their labor in this period for the 2 weeks of work they've given me from January 1st to the 15th, and ostensibly helped my company generate revenue. So notice the split source, right? Don't let it be too confusing. You'll see how at the end of this period, in step 4, we're going to accrue more wages payable for the work that our employees have done, but has not yet been paid. So the part that settles off the payable is reducing a liability from the prior period. The wage expense I'm recognizing now is net income because I'm matching it against revenues I'm making in this period. And that reduction in cash is an asset, right? A reduction in assets. Okay. The next piece. Richter sold $50,000 of its equipment. Accumulated depreciation associated with the equipment at the time of the sale amounted to $5,000. The company received $47,000 for the sale of the equipment. So let's break it up into pieces, right? $50,000 of its equipment. So that's going to come out of my equipment account, which is at 750, which is at 700. The accumulated depreciation up to that point amounted to 5,000. So we need to get rid of any amount of accumulated depreciation, which, hey, it's some of this here, not all of it, but a portion of it, 5,000 of the 70. Once we get rid of the asset, which has accumulated depreciation associated with it, we not only have to credit the asset, but we should also get rid of the accumulated depreciation, because if we get rid of the asset but not the accumulated depreciation, we have a bit of this account that means nothing now because the asset that it was tied to has been sold. So we get rid of both of those pieces, and then we account for the amount of money we received. So let's start with the easiest part, which is, hey, we got $47,000 on this sale and it's at 115. So I debit cash for 47,000. Now, as I mentioned, we have to get rid of the equipment. Well, how are we going to get rid of the equipment, right? Well, the equipment is at 700 and we just sold 50,000 of it. It's a debit balanced account, it's an asset account. So to get rid of it, we would need to credit it. To get rid of the accumulated depreciation, right? This is a credit balanced account. We would need to debit the accumulated depreciation in order to reduce it down by 5,000. So I have a debit to accumulated depreciation to offset the 5,000. And I have a credit to my equipment account to reduce it by the $50,000 of equipment sold. Accumulated depreciation is, like allowance for credit losses, a contra asset. So it is tied to my equipment and reduces the value of that I record for my equipment on the balance sheet. Like any contra asset, it still follows the rules of assets. When I debit it, it increases assets. When I credit it, it reduces assets. The equipment I sold is reducing assets because I'm crediting the asset. Now, I do not have debits equaling credits. And that's a problem. No journal entry will be correct if the sum of its debit accounts does not equal its credit accounts. So I have $52,000 here, but only $50,000 here. The missing piece would be a gain on sale. The way you can think about this is I received $47,000 of assets. In order to receive that $47,000 of assets, I had to give up an asset with a net value of 50 minus 5. So that's 45. So in order to get $47,000 of assets, I gave up assets with a net worth of 45,000 on my books. Therefore, I have a gain because I received 2,000 more assets than I gave up. The gain increases net income. It is a net income account. The difference between a gain and a revenue is revenues are part of the core operations of the business, whereas gains are not part of the core operations of the business. Revenues are core operations, gains are not core operations. So this company, for example, is in the business of selling its inventory. It's not in the business of selling its equipment. The equipment of the company is not its inventory. This is something that helps the company over time generate revenue. So not its core operations to sell that equipment. All right, on 116, the company was paid $24,000 in advance, very important, for services to be provided in the future over a 12-month period. And it tells us that, Richter is going to anticipate earning this revenue evenly over the period, evenly over a year, as it provides services on a consistent monthly basis. So someone wanted to prepay us. We're not prepaying them, right? Up here, we prepaid, but we prepaid other companies. In this case, we're the ones who are being prepaid. So it's a different entry. Here on 116, I did receive cash. And I received cash in the amount, just to remind myself, 24,000. And can I record revenue? According to the criteria of the revenue recognition, I cannot. I have realized the asset. Someone has paid me money. So the expectation of payment is not in question. The problem is I haven't earned it yet. Not on the 16th. I'm going to earn this evenly over the course of the contract. So they pay me cash. I credit an account called deferred revenue. Now, deferred revenue is the same thing as unearned revenue. But in life, and only in intro, really, do we call it unearned revenue. So everywhere else, in intermediate and beyond, in life, they call this deferred revenue because they're not going to record the revenue until they've done the work at a later period. So I received an asset, but now because someone paid me in advance, I have an obligation that I need to meet. All right, that takes care of that transaction. On 123, I paid off some of my outstanding payable with a vendor, with my inventory vendor. So again, I'm paying off my accounts payable. $20,000 have been paid. Reduce accounts payable by 20. And if I'm paying them off, that's being paid with cash. We've already seen this transaction. We're just another instance of having to pay off our current liabilities over time. And this happened on 123, closing in on the end of the month, almost there. The next piece, the company recorded product sales revenue of 10,000, paid in cash. and the inventory sold cost the company 4,500. So we now, again, we just have another one of these product cells. Make sure that you remember to not just record the revenue. So we received cash, and we received cash of 10,000. We provided the product. We realized the payment, our cash payment. So we can record the sales revenue here. We don't have to defer the revenue. We've met both conditions of the revenue recognition criterion. All right, but we also have to remember I got some cost data, so I need to include that. The cost was $4,500. So we're still on 123, or sorry, no, this was 125. 125, where I record the cost of goods sold for this inventory I sold was 4,500. And I credit my inventory account for the amount of inventory that has left my building or left my business due to the sale. Reduces net income. This reduces assets. Richter made another collection from its outstanding customer accounts. Remember, outstanding means still a balance in those accounts. Customer accounts, that means customers who owe us money. Remember, again, accounts receivable. So 30,000 cash came in just from collecting on accounts that already were recognized at one point as revenue when I made the credit sell. They just paid later. So all we're worrying about here is the cash flow. No net income effects here, because the net income effect would have been recognized, for example, let's say up here when we made the sale. Just remember, we're working under an accrual system. We do not have to have cash exchange hands for us to record a revenue. We want to record that revenue when the action happened, when the real action, providing the product or service. Now, this is just a collection after the fact. Right? That's the easy part. And then finally, we have the company issuing 1,000 shares of $1 par value stock, which was trading at $20 per share at the date of issuance. So they made a small stock issue here, just raising some money. So they sold 1,000 shares at $20 per share. Issuing, that just means selling. So it's just, market lingo for I sold it. Here, I would record the cash coming in. I sold 1,000 shares at 20 per share. So that's $20,000. Now, with common stock, that has par value. The accounting is a little silly, maybe, right? Par value is just a preset value under which the stock cannot be sold, right? So companies tend to sell it or set par value arbitrarily low. But textbook examples, usually it's $1 par value. But I mean, in real life, usually they go down to like 0.00001 cent. And the company sets this when they're working through their registration files and registering for an IPO to issue stock, they get to set the par value. So they can set it arbitrarily low. But here, a $1 par value for 1,000 shares, what that ends up doing is just limiting the amount that we put into a common stock account. So 1,000 shares with a $1 par value is just $1,000. Now, we're missing, of course, $19,000. The idea here is each of our new investors pay $20 per share when the par of it was just one. And that leaves us with $19 per share left over. So this is like a $19 excess over par. Take that and multiply it by 1,000, right, per share. So 1,000 shares times 19 gives me 19,000. That's the amount I'm missing here. And anything paid in excess of par, we call additional paid in capital, often abbreviated as APIC. But you don't earn the abbreviation until you know the entire name of the account. Okay. Because nothing can be more embarrassing than knowing an acronym, but not knowing what it stands for. Right. So we got cash, that's an asset. It's coming in, I increase assets. Common stock and additional paid in capital, these are direct investment equity accounts. This is the first time we wrote a change to equity. Very often, not very often, will changes happen directly to equity, especially in intermediate ones. So stock issues are one of those cases in which our equity is increased. Now, this all happened on January 30th. We have one space left over. That's okay. We have everything appropriately reported. The extra space was just in case someone was working this on their own and decided to, oh, I've really just put an extra cash line here, which would have been fine. All right. So those are all of the journal entries. That completes step one. We are at the end of all the transactions that happened during the period. The rest of what we're going to do here, step 2 and 3, that will follow up, is just take this sort of loop wrong way, mass of information and make it more digestible. It's important to have that chronological ordering for the day by day transactions of the company, right? You got to have this record as things progress over time. And in a real company, I mean, you're going to have multitudes of transactions on every single day. So this becomes a little overwhelming to look at. Look, I'm dealing with asset accounts, still assets, and I got some net income thrown in here, some liabilities, things are going up and down, cash is all over the place. We need to organize it a little better. That is in step 2, which will be in the following video.